What's up, homies? My name is Matt Lurker, and I teach people everything they need to know about saving, investing, and financial freedom. If you're new here, stay tuned because today's video is a back-to-basics approach on getting started in investing. So first, I'll define a few terms for you, and I'll tell you what you need to know about them. And again, this is just a back-to-basics sort of video, so I'm not going to get into really complex investment strategies, but I'll tell you everything you need to know to get started. And then lastly, at the end of the video, I'll tell you the best investment that you can make today to get started with investing. So the first term that you need to understand is stock. What is a stock? So a stock is a part ownership in a company. So if there's 100 shares and you own 2 of them, then that means you own 2% of that company. Now this doesn't mean that you as a shareholder could walk into, let's say, Apple. If you own shares in Apple, you can't just walk into an Apple store and say, that's my MacBook. Yeah, I'm taking that with me now. That's my 1%, or that's my 2% of the company. What it does mean, though, that as an investor in that company, you think they are going to make money. That's the point of a company, after all. You know, every company, no matter their good intentions, the bottom line is what matters. And so we're all trying to make money out there. So as an investor, you believe in this company and you think they're going to make money over time. So what you do is you buy a couple of shares and then you make money in one of 2 ways, typically, as an investor. The first way that you might make money as an investor is by selling the shares of stock. So let's say you buy Apple stock for $100, and it's not trading at $100, but we'll just say Apple because everyone knows them and 100 is easy to work with. So let's say you buy Apple stock for $100, and after 10 years, their stock is now trading at $200, or that stock has appreciated. So that means as an investor, if you sell your shares, then that means that you would recognize a 100% return on that investment. And I'm not saying that you should just hold any share for $100, but I am saying that this is a really simple way to understand that the first way you make money when investing is by first purchasing an asset or a security or a stock, and then waiting for some period of time. And then when that security or that stock is trading at a higher value, then you sell and the difference is your profit. And the second way that you make money as an investor is through dividends. Dividends are a really popular term right now because everyone's into passive income, but you need to understand that a dividend is when a company is making so much money that rather than reinvesting in the company, they pay that money out to the shareholders. So instead of the company growing and building and their stock price ultimately increasing in value, instead they pay that money out directly to the shareholders. Depending on the company, this typically happens quarterly or annually. You do need to understand, though, that with dividends, not every company pays a dividend, and so you can't just buy a stock and expect some sort of income stream every month. You need to look into the company or have someone else look into the company for you if you're paying an advisor. Now that we understand what a stock is and how we make money through them, where do these shares even come from? So the next thing is an IPO, or an initial public offering. And there's a lot we could go into with this, but really all you need to know is that an IPO is the first time a company goes public, or the first time that a company becomes listed on the New York Stock Exchange, which is the primary stock market here in the United States. At the initial public offering, or the IPO, the company issues a number of shares, usually through a bank or a broker or some other third party, and then investors like you and me or hedge funds or someone else, they buy those shares. And then those shares are then traded on the New York Stock Exchange. So again, not going into a ton of detail on IPOs, but it's the first time a company goes public. So a private company, their stock is not traded publicly. But then when they want to grow and raise a lot of money right away, they can go public and they can have an initial public offering. And the third term that you need to understand as a new investor is volatility. When talking about stocks, volatility is any time that the price of a stock moves quickly up or down. This can also be referred to as momentum, but typically we say volatility. So when you hear about a company like Tesla or something like Dogecoin recently, then surrounding those companies, you know that there's a lot of volatility because the price of Tesla shot up so high, so quickly. And the price of Dogecoin, just this past week, skyrocketed to the moon. I think they hit like 36 cents. Anytime we see a company's share price moving so quickly, though, we need to be cautious because when there's a great deal of volatility, that means it's moving quickly up and also quickly down. And so this leaves a lot of room for profits, but then also a lot of risk for losses. So when it comes to investing in the stock market, those are 3 terms that you absolutely need to understand. And I know that since I just brought up Dogecoin, I now have to explain cryptocurrency. So I'll briefly go into that. And again, this is just a back to basics video. There's a lot more depth you can go into with cryptocurrency. Cryptocurrencies are the first new asset class really since the 1800s, and they're not yet widely accepted. And for good reason. There's a lot of speculation about whether or not any of these will actually be worth something as an investment in the future. You've probably heard of things like Bitcoin, Dogecoin, and Ethereum. Those are some of the most popular cryptocurrencies in the space right now. And again, there's a lot of speculation whether any of them will be worth something in the future, but I'll try to give you an objective and unbiased answer on what they are. So a cryptocurrency is not ownership in a company like a stock. But like the American dollar, they're also not typically tied to anything physical as a representation of their value. Cryptocurrencies can be worth whatever we, the people, think that they're worth. And based on the mathematical equations and the computer programs used to create these currencies, their value is determined by the supply of the coin digitally and by the demand of the investors who would like ownership of that currency. And again, it's not tied to anything physical here, which a lot of people may be concerned about, but those people also probably don't realize that that's how the American dollar works as well. Because even then, there's more money tied up in just digital bank accounts and investment accounts rather than physical bills floating around and being stored in vaults. And if this next part doesn't make sense to you, that's okay, just forget I said any of it. But cryptocurrencies in general are units of a reward given to a computer that has just solved a very complex math equation. And that unit of a reward, that coin, is then known as the name of the coin, like Dogecoin or Bitcoin, which respectively, Dogecoin is trading at about 35 cents right now, and one Bitcoin is trading at about $56,000. And if you want to know more about Bitcoin and other cryptocurrencies, the explanation I just gave is a huge oversimplification. And so if you want to know more, you'll have to do more research. But again, this is just a back to basics video, just giving you the knowledge that a beginner investor should have. Next, I'll talk about the different types of funds that you can invest in, how they're a little bit different and how they're the same. And then finally, I'll give you my recommendations on how to get started. So these next three items are very similar, with two of them being nearly identical sometimes, and the third one being slightly different. The first fund that I want to talk to you guys about is an index fund. An index fund, put simply, is where you can buy shares of this fund that tracks an index like the S&P 500 or the NASDAQ Composite Index or the Russell 2000, any index you can think of. This fund tracks that index's performance. And so this is a great option for someone who doesn't want to pick their own stocks and shouldn't be picking their own stocks. So this is a great way to just diversify. The next fund that I want to talk to you guys about is an ETF, or an exchange traded fund. And I've talked to you guys before about ETFs in another video, but put simply, an ETF is just like an index fund, but it doesn't necessarily track an index. It's more of just a basket that someone has picked a bunch of companies and put them into that basket and then left alone. It's not actively managed, but it typically tracks something like a sector of the market. So that could be the technology sector, or maybe retail or consumer staples. Like index funds though, ETFs have very low fees compared to other investments, and they're a very easy way for someone to diversify their portfolio without actually having to pick different companies to be invested in. Lastly, when thinking about funds, you need to be aware of mutual funds. And these are very similar to ETFs and index funds in the way that you're investing in an entire basket of goods, not necessarily just a single company. However, the difference here is that there is a fund manager, and he's got to get paid. So a mutual fund comes with higher fees, which may not sound like much if it's just, 0.5%, 1% extra, but it really adds up over time. And mutual funds typically perform just as well as index funds and ETFs, but they also typically come with higher fees. And you'll find these in a lot of 401ks and other company-sponsored investment accounts. But typically, if it's me and I'm not forced into mutual funds through like a 401k, I try to stay away from them. So welcome to the good part of the video. If you made it this far, go ahead and hit that like button on the video. And as a token of my appreciation, here's this nice picture of some bears. Now, for how to get started in investing. So the first and most important thing you need to do is look at your time frame. How long are you going to be investing this money for? Because this will affect everything else. And if your time frame is longer than 10 years, then it's my opinion that you need to adopt an aggressive mindset with your money. Because over 10 years, the market's going to go down, come back up, and go back down, and come back up again. That's what the market does. There's going to be a recession in 10 years. There's going to be a bull market in 10 years where the market's going up. But as a long-term investor, we can stomach the downturns because we're in it for the long haul. It's okay if our value drops because it's going to come back up. In fact, there's never been a 20-year period in history where the stock market has had a negative return. So for most of us, our time horizon is pretty far out, and so we need to get okay with taking some risks with our money. Once you've determined your time horizon, you need to pick a broker. And this is where you say to yourself, who do I want to do business with for the rest of my life? And that's not really true because you can transfer account balances, but ideally this is a long-term investment, so you may be with them for the rest of your life. And so you need to look at the fee schedules. This is the most important thing to consider when comparing different brokers, because they should have low fees. If they've got really high fees for their accounts, don't do business with them. There's tons of brokers that you can find in the online, in the digital age, and so there's no reason to be with a broker with high fees. And most of the top brokers have very similar fee schedules. They're all pretty low and they're all pretty easy to work with. So if you don't know of any, some that I like are Vanguard, Fidelity, E-Trade, and M1 Finance. They're all great, have low fees, and are pretty user-friendly. Next, you need to open your account and fund it. And so you've already picked your broker at this point, and so you're probably looking between either a Roth IRA or a normal brokerage account. And for most people, if you're under 40 and you make less than $140,000 per year as a single person, you should pick a Roth IRA. I go into a lot more detail on Roth IRAs in another video, and so I'll have a link to that in the description. But just know that you're going to save a ton of money on taxes, which is what we want here. Finally, you need to decide what you're going to be buying into within your account. So again, if you're most people, you've gotten your broker, you've picked out a Roth IRA because that's probably what's going to be best for you. And now you need to decide what you're actually going to invest in within that account. So if you remember index funds and ETFs from, I don't know, like 2 minutes ago, you better not have that short of a memory. I hope you remember. But if you remember index funds and ETFs, those are the things you want right now. Because for most people, we don't need to be picking out individual companies one by one, looking through their balance sheets. These companies should be financially sound, no doubt about it. But as an individual investor, we don't have the time to pick out those investments on a one-by-one basis. So an index fund and an ETF, those give you a great opportunity to diversify across companies that someone who works in the field has already determined to be a good buy. And so this is going to shield you from a lot of risk of just dumping all your money into one company. You can buy a total stock market index fund, or you can buy an S&P 500 index fund or an ETF that tracks that index, because this is what's going to go up over time. The S&P 500 will continue to grow. Those are sound companies. Those are companies that make money. Those are companies like Apple, Microsoft, AT&T, Visa, Coca-Cola. Those are all established companies that have been turning a profit for decades. And so this is where you want to invest your money. We don't need to get caught up in just the individual stock picking. It can be fun with some of our money, but for the bulk of your money, pick out a good index fund or ETF that covers either the stock market as a whole or just the S&P 500. Now, finally, the last step is to decide how much you can invest every month, and then realize that you can and should invest more. I guarantee you that for 99% of the people out there, if you look at your spending for the past month, there's something that you bought or spent money on that you could have gone without, and you could have invested that money instead. So think about that for a second. A good goal is $500 a month or 15% of your income, whichever one ends up being more. But again, once you land on that number, look back at your spending and find where you can invest more, because it's going to make a huge difference. These dollars today that you invest are going to be worth so much more 30 years from now when you retire. So guys, that's going to wrap it up for today's video. I would really appreciate it that if you made it this far, go ahead and like the video and subscribe to the channel. New videos are coming out every Tuesday and Thursday to help you get started and to keep going with investing. As always, I love you guys, and I'll catch you next time. We're open to the biggest companies in the stock market. That was awful. They are actively managed, which means that, dang it, that was great.